Splash landing, why liquidity is all that matters and is great for gold. Hi, everyone, and welcome to Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we have a very special guest, Joe Brombal, who's here to discuss quite an interesting angle on where we're sitting currently in terms of the markets and the most likely path forward. So how are you going today, Joe?
Yeah, good mate. Happy to be here for the first time. So
Excellent.
yep.
No, we're very glad to have you on. The news piece today is something that I know you've been looking at, and it's something I'm really interested in as well, because it really clarified a few things for me in terms of why we appear to be seeing strength in the markets generally. And I mean, I'm talking about crypto, gold, stock markets generally, despite a background where everyone appears pretty certain that we should be heading to some form of recession. So that would see markets turning down. Now, the missing piece of that puzzle, according to the news today, and what I know you'll want to talk about, is liquidity, which kind of makes some sense that that's starting to pick up and that's driving these things. So can you maybe start off by just giving us a bit of an overview of what is meant by this term of global liquidity and why it's so important, even though it's often overlooked?
Yeah, so I think from my perspective, the liquidity is defined as the ease of financing in the global financial system, and really just people's ability to borrow, whether it be people themselves, institutions, banks, or even governments. So obviously, the more borrowing and the better conditions for borrowing, the more liquidity you're going to have within the system, within the financial markets.
So it's really just about availability to access cash, where, like you said, whoever you are, isn't it?
Exactly right. Exactly right. Just as a home buyer needs the bank to access liquidity to buy a house, to buy an asset.
Yep. So
Exactly
it's quite a broad term then, and
Yep.
when we're looking at it here. So we're seeing, as it talks about today, we're seeing an uptick in liquidity globally. Where would that be coming from then?
So at the moment, we obviously know that the US tightening in the form of QT and rate rises. A lot of other countries are doing something similar. Where that's being offset at the moment is actually China. China are pumping a lot of yuan into their financial system and into their economy. Also, to a lesser extent, you have Japan, which are doing what they usually do in the forms of liquidity. Nothing's really changed there. So that would be the two main sources at this point in time, which is probably why a lot of people from Western economies don't really see it or completely missed what's going on.
And that's a really interesting point about China too, because obviously they're coming off the back of reopening after COVID. You know, there was a long lockdown, and when you say about us in the West, we feel like we've moved past that to a large degree. A lot of that was really well and truly over last year. So when China's only just starting to do that now and is pumping that liquidity in now, we saw the same thing here, didn't we, at the end of COVID?
Absolutely. And that was reflected in asset prices everywhere. But you could have bought anything and it would have went up. So it's just that we aren't seeing it on the surface from our own economies. We only see what's right in front of us. When really macro is a global event, effectively. It's the amount of money that China is pumping through at the moment is greatly offsetting whatever is being tightened in the rest of the world.
Right. So, because obviously the concern's inflation. So, if you're talking about the US, the reason that they're going down this tightening path is because they're trying to pull money out of the system or pull liquidity out of the system to lower inflation. And then you've got China, who effectively have given up on that because they're really trying to pump money in to really kickstart the economy after the COVID lockdown. So, directly fighting against each other theoretically in what they're attempting to do. Where does the US really fit in there? Because there's a concept I found really interesting that I didn't really understand before, this idea of reverse repo, where you've got excess reserves receiving interest. So, or a roundabout way of excess reserves receiving interest anyway. Can you maybe explain a little bit of that?
So everyone remembers the global financial crisis, and that was effectively it was a crisis in collateral, and the banking system was under collateralized. So a lot of regulation has come into place where the banks need to keep large amounts of capital to and excess reserves effectively to make sure that they're always solvent. So, and what's happened from there is they've obviously built up large amounts of capital in the form of excess reserves, and they park them in the reverse repo facility, which is a facility that the central bank pays interest on. So they're effectively getting interest on money for doing not a whole lot, really. Now that money itself eventually finds its way into the real economy via lending, potentially bank dividends, all that sort of thing. Like, it doesn't just stop there with the bank, so it does find its way into the real economy, which is an improvement which will be an improvement on liquidity, and that's what we're starting to see. It's not there out in the open. It's not a completely well understood system, but it does have an effect on liquidity within the US and the rest of the financial world.
And that's really interesting as well, because if you think about that, you've got interest rates going up. So you would assume then that they are actually earning larger amounts than ever before on those massive reserves.
Exactly right, 100%. So yeah, it's certainly beneficial to the banks in terms of their cash flow and their balance sheet, and the knock-on effect is their ability to lend and get money into the actual economy, even while rates are rising and quantitative tightening continues.
Yeah, right. And that was a bit of a light bulb moment for me too, going, well, even though the Fed might be undertaking tightening, we have to realize there's still money coming in. So
that's right. We're only seeing what's on the surface, and that's fair enough. To the majority of people, they're only going to see rate rising, and if they look a little deeper, they might see quantitative tightening, which, as we all know, is the opposite of bond purchasing. So, to the average person, all that matters is rates and QT. But when you're really looking under the surface of the financial plumbing, there's more to it. There's a lot more to it than just rate rises and QT. And that's the argument I hear all the time. The argument all the time is, the Fed are going to continue raising rates, which they probably are, but at a slower pace until they see some economic deterioration. And they're going to continue QT, which they probably are as well. But these are also things that aren't going to continue on forever.
No. And that's the point that you're making there too, isn't it? That even though they can still continue those things, but if you've got offsets, like you talked about China, you've talked about overseas, but also even domestically in the US, if you've got offsets from things like that reverse repo facility, then the net effect could actually be stimulative. You could actually have more liquidity coming in, even though on the surface they're saying they're pulling liquidity out.
Exactly right. It's almost a subtle way of stimulating the economy without actually being very obvious on the surface.
Yeah, fascinating. And how does that tie in with what we're seeing with the US dollar currently? Because we've seen weakness there that also seemed a little bit counterintuitive initially.
Yeah, so obviously the dollar's come off its top. We were in a downtrend for the last few months. We've had a bit of a bounce at the moment, which is to be expected. Nothing goes down in a straight line, but I do expect it to roll over in the 2 to 4 weeks, or however long it takes. But it's certainly not, I don't think it's a sustainable trend. And that leads into, a weaker dollar is obviously better for the world economy because everyone borrows in dollars. So if your domestic currency is stronger against the US, you're able to borrow more US dollars to finance whatever your needs are within that economy. And that's stimulative to that particular economy as well. So that's an increase in liquidity, and that liquidity's got to go somewhere.
And that's really a theme that's coming out here of it's not just US. Like, we've got to remember it's a whole world out there. Right. So, something that can happen, they might be attempting to do something in the US, but the flow-on effects of that create liquidity elsewhere, don't they?
That's right. Exactly right. So we've got to look outside just the US. Like, obviously, US being the most important economy in the world at the moment, followed closely, arguably, well, it would be China, but we need to look outside the single economy and what they're doing on the surface. So it's very complex, and sometimes you just got to look a little deeper.
Yeah, sure. And probably continuing on that theme, I'd just like to ask you about global debt refinancing, because that was another penny drop moment for me, realizing the debt is just extraordinary when you look at global debt as a a hole. And obviously, central banks, first and foremost, they can't let the system fall apart. And that's what you were saying before about the global financial crisis. We came to the brink of them realizing, no, we simply cannot let that system fail. So if you've got a whole lot of debt that needs refinancing, then that requires liquidity. So is it really that central banks simply don't have another choice? They have to continue providing liquidity regardless of what it ultimately does for things like inflation.
Yeah, well, they're well aware of the debt problem within the global economic system. It's how our debt-based system works. You need to constantly be stimulating or producing more debt to pay off the old debt and keep it rolling. So, as you pointed out, they figured this out a long time ago. The 2008 financial crisis, they didn't do anything. They didn't see it coming, so to speak, but they realized that the only way to save the system was to raise the value of the collateral. And as we know, the collateral is the what's the word I'm looking for?
Essential sort of.
Well, if the collateral falls, you can't refinance anything.
That's right.
It's like your home. If your home falls in price, the bank's not going to let you refinance anything. So,
And there's flow-on effects. There's constant flow-on effects from that, isn't there? Because if you can't refinance your house and you have to refinance it, and like there's different situations around the world of how bank financing works for property, for example. But if you're in a situation where you have to refinance your house and you can't, well, what's the alternative? The bank repossesses the house, then has to sell the house,
and that has a knock-on effect for the next person that's borderline on their. The next person who's borderline needing to refinance their debt, or their collateral of their house is fringing on negative equity. If all of a sudden we have all these sales, that's going to bring the entire market of the properties around them down, and all of a sudden they need to be liquidated. It's just that flow-on effect, and it's exactly it's what happened in DFC, and it's what happened in COVID. The Fed and the government knew that if they'd let the effectively stop, so they had to bring up the value of the collateral to stop the whole entire system falling down. And you saw that with huge quantitative easing and bond buying. You saw that with the Fed with their special purpose vehicles when they teamed up with BlackRock to effectively put money straight into junk bonds to stop corporations defaulting. It's just all about the collateral, and they've got to keep it afloat. And if it doesn't stay afloat, the whole thing comes crashing down.
Yep, and that does make a lot of sense why we are in the situation that we are and why we need to dig deep, as you've said. So finally, what does all this mean for risk assets? Especially, I know you look at Bitcoin and gold. That's something we're interested in. That's something our viewers will be interested in. What does that mean for those assets?
Well, I think we've already seen global markets, particularly Bitcoin, gold, and Nasdaq and S&P. They all S&P and Nasdaq bottomed a little bit earlier than crypto did. But if you look at what the global liquidity index, it bottomed around October, November, and that coincided with the bottom of Bitcoin risk assets, Nasdaq, Tech, and S&P. And I don't think that coinciding is by chance. I think that's 100% causation from the liquidity that's been starting to turn.
Yep. Now,
we're not actually in full liquidity mode, obviously. We're not, we're nowhere near the levels than what it was over 2020, 21, even a little bit of 22. But the point is that it's actually started to turn up from its bottom. It's formed a bottom and it's starting to turn up. And I think the markets have, being forward-looking, have sniffed that out, and that's why we have seen the bottom in those markets. I'm quite confident that we've seen the bottom, barring some other unforeseen event. I don't think that we go back to the lows or even past them. Certainly
no, and they're slow trends to change as well, aren't they? Because once
that's right.
The Bank of China, for example, is not going to all of a sudden change path tomorrow. It's more likely to be, we've chosen this path for a reason. We'll wait to see that flow through.
Exactly right. And we're only going to see over time. It might take 6, 8, 12 months, we're only going to see the other central banks fall in line with what the Chinese are doing anyway. As the economic conditions start to deteriorate and unemployment starts to rise, if we do start seeing those defaults, then all of a sudden the taps get turned on again, because that's the only way the system survives. They can't. The central banks and the government, effectively one being, as far as I see it, they're supposed to be independent, but I don't see it that way at all. They work together. They're not going to have the whole system falling down. Otherwise, there'll be people rioting in the streets for starters, and it's easier. It's easy just to write a check at the end of the day.
Yeah, and that ultimately that is their primary function. Like, they simply cannot let that happen.
That's right. That's right. Well, they've seen, like, the GFC was a precursor to what happens when you let the collateral fall, and as we for those who remember, it was it wasn't a nice time to be a politician or anyone in the central bank at that time.
No.
So I'm sure they don't want to see that again.
No, I definitely agree with that. Joe, thank you so much for all your discussion on this today. I find it absolutely fascinating, and it makes so much sense when you understand that it's liquidity driving everything else that we're seeing and not the other way around. So thank you for that.
Yeah, 100%. So a simple way to look at it is, from my perspective, a lot of people believe that the economy leads the markets, when really I see it as it's liquidity, then it's markets, and then you have the economy knock-on effects.
Yep.
So if you think of it in terms of that, markets being forward-looking and markets reacting to liquidity, it's liquidity, markets, economy. And I think that's what a lot of people are getting around the wrong way at the moment.
No, that's really valuable way to look at it. So thank you for that. Thanks everyone for watching. Remember, you can reach out to us with any questions or comments on the social platforms. We'll do our best to respond. I'll be back with our next installment later in the week. So until then, good luck out there in the markets, and we'll talk again soon.
Thanks, guys.